Next in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome back. You are listening to the Financial Survival Network. This is Kerry Lutz, and the market in a bit of a downturn, which not surprising because we went over 800 days without having a 10% or more correction. That's some kind of record in and of itself. What's ahead for the stock market, for gold, and for the economy? Well, let's talk to Rick Ackerman of rickackerman.com. You can get his free newsletter, daily newsletter, just by going onto the site and subscribing. Rick, welcome back. It's been a while.
Thanks for having me back, Kerry.
Hey, well, always a pleasure. So, hey, you watch the short term, the medium term, constantly. Where do you see the stock market right now, Rick?
Well, I think we've been in a broad topping pattern, and it's possible that last week's 300-point decline in the Dow one day was a shot across the bow. You never want to count the market out entirely, and I have to say, strictly speaking, if there's someone out there blathering away about how the Dow is really on its way to 30,000, how can it not get there with all the Fed stimulus? I don't have a perfect counter-argument. The market has defied expectations and even the imagination for so long that you can never be quite sure. All the ducks seem to be lined up. We've got an economy that is barely limping along. And, of course, that's notwithstanding the 4% GDP growth that was reported for the second quarter. Anybody actually living in the economy, meaning working in a business or owning a business, knows that 4% number was an absolute lie. What we've got is still an asset inflation. Makes people feel like things are not too bad. You look and you think, well, how bad could the economy be if we got the Dow trading within 3% of all-time highs? So I think the Dow, the stock market is really a critical psychological buttress, and it kind of taints our perception or colors our perception of all those statistics. It would look pretty ugly if the Dow were 5,000 points lower. So just keeping the stock market up has been a major or a project for the Federal Reserve, but we're slipping here. It could happen very precipitously.
Well, what about the so-called wealth effect?
Well, the wealth effect in Alan Greenspan's telling of the story is that inflated home values actually constitute wealth. But what we know from experience is that inflated home values simply constitute more borrowing power. So it definitely helps the economy, gives it a shot in the arm when people are refinancing their homes and using the money, in many cases, to feed another bubble, which is occurring in colleges and universities. They keep buying the low inflation environment that we've had. If you got a kid in college, the tuition is going up and up and up and up. But of course, that's fed at this point by a $1.4+ trillion stream of wink student loans. So there are just so many places where the economy could unravel, and it's only with a serious fall in the stock market that those reasons will become, let's say, manifest.
Yeah. So you think it really looks like it's in a topping pattern right now, huh?
Yeah, it really feels that way to me. I mean, I suppose if you've got that bullish imagination that shopping mall developers seem to have, you could say, well, no, the market's just pulling back here and we're going to get a blast to new highs. But I'd have to say if the market does somehow get short squeezed to new record highs, it would look to me like a perfect bull trap. Because at that point, if everybody isn't all in already, they would certainly be all in then, thinking full steam ahead. And of course, the last bear would be blown out of the water. And I don't think people realize, generally speaking, how important bear short covering is to the bull market. Because typically, there's no bull out there that's quite bullish enough to buy stocks in a way that pushes it to new all-time highs, pushes it past previous tops where you've got a lot of supply. It's only short covering that can accomplish that. So, looking at the market today, I would say the bears were not too nervous at all. And, of course, you need enough buoyancy in the market on a given day to push it up enough that you get to that trigger threshold where short covering happens. And the fact that we didn't get that today is not necessarily indicating that it's over, but I'd have to say it should be a troubling sign for bulls that there's not enough wafting power in this market to trigger a short squeeze right now.
Yeah, so what's the best way to play this thing, assuming that you're not just going to sit out on the sidelines?
I love the long-term treasuries here, particularly strips where you're not buying a stream of interest payments. You're simply buying a bond or a bond vehicle that's just discounted to a maturity in, let's say, 2044. The further out you go in time, and you can go out a little further with some of these California education bonds, things like that, to a 40-year maturity date. But the further out you go, the more leverage you're going to have, the more in capital gains you stand to make if interest rates come down. And I think that's what's going to happen. I feel like we're headed into a recession here, and stock market falls. It's going to push a lot of money into an unwind, meaning out of stocks into bonds. So the big error that everybody has been making in the last 5 or 6 years is in thinking that all of this credit stimulus is going to produce inflation. It really hasn't. The larger overhang, the juggernaut, is deflationary, and it has to do with keeping the quadrillion-dollar derivatives bubble inflated. So that's what we're pushing against, and it makes what I call grocery store lettuce bin inflation look like nothing. So in any case, if we had bond yields right now, if they were to come down in a weakening economy to the lows of 2012, you've got a potential 40% gain in long-term treasuries if that were to happen within the next year. And looking at some of these tax-free munis, which of course are most appealing to high-bracket investors, the gain there, if you had a fall in interest rates down to 2012 lows, you could make gains approaching 30% with the tax-free munis. So strategically speaking, I'm trying to do this with my subscribers using equity-based vehicles, one of which is the symbol is TLT, and it is an equity-based proxy, an exchange-traded fund for bonds with maturities of 20 years or more. So we're essentially doing calendar spreads. We're not even buying options, which I think is a losing strategy because the price of those options are prices are very well handicapped. So we're doing spreads where we buy, an out-of-the-money strike going out a few months, and then we just keep short selling the weekly expirations at the same strike. By the time November rolls around, even if bond prices remain stable and don't go higher, you still get your money back, and you're sitting essentially with a free call come November at formerly out-of-the-money strike. And it's just a very cheap way to play a bullish scenario. So I'm just kind of putting two things together, the expectation of a relapse in the economy. And I think that the fact that they knocked bond prices down so badly on the news of that 4% GDP growth, that was a gift from heaven, really, because no one really believes the economy is growing at 4%. And if that's the case, you should be in there essentially betting on lower interest rates.
Yeah, and you think there's room for lower interest rates here, Rick?
Well, absolutely. And again, the fallacy is, people look at the federal funds rate and they see it's at zero, and they say, well, it can only go up from here. The problem is, or the mistake is, that they think that if this administered interest rate goes higher, that it's going to push the yield curve up at all points along the curve. So, but the fallacy there stems from the fact that the federal funds rate is fixed by decision, but bond rates, T-bonds, are determined by market forces. So you could easily have a situation where the Federal Reserve holds the federal funds rate at zero, but where an influx of, let's say, let's call it flight capital into bonds prices up, and the yields correspondingly lower. So I think everybody's making the same mistake there, and that's why the long-term bonds have been a great bet in 5 of the last 6 years. And even in that one losing year, it wasn't such a bad year. It was like making 3 or 4% as opposed to 22% plus.
Right. So really, we're in this deflationary environment, which is consistent with a depression, and the fact is that interest rates, are probably going to go down.
Well, I have to say it's tricky. I've had some nasty debates with the inflationists out there, and people always say, "Well, Rick, what are you, stupid? Have you been to the grocery store lately? Have you paid, for your health insurance or whatever?" But all of those things, I would say they're either anomalous, like the food prices are not being pushed up as much by Fed stimulus as they are by drought in California, where I think something like 40% of the country's produce is grown. And, even on the meat side, you've got a virus that's wiped out a huge population of young piglets. And so we've got inflation in the grocery stores, but I think it's less a product of Fed stimulus than it is of factors that are unique to the food supply chain. And, we have got inflation in tuition, but that's not fed directly by stimulus. It's fed by a one-off factor that we see in the huge growth in student loans, which are now running at $1.4 trillion, as I mentioned. So those things make the economy look inflationary, but not really, because if you correlate it with incomes, which have been stagnant for years, you might actually come to the logic that what we call inflation is actually deflationary, meaning that if your paycheck is X dollars a month and the cost of essentials like food goes up, you have less money to spend on other things. So we don't have an inflation that feeds itself as we did during the 70s. There, you had pressure on wages, and you could see inflation as kind of a vicious cycle. But we're in a situation now where the cycle has nowhere to go. It can't spin out of control simply because wages aren't growing to pay the inflated prices.
Right. So the only thing that can pay the inflated prices is an increase in easy credit. We'll return. We'll talk about this increase in easy credit, lessen credit standards, i.e. the auto bubble, on the Financial Survival Network.
FSN Radio.
When your accountant wants tax-free income, this is what he does. Accountants know the law. They also know that any American could legally get paid up to 3 times per month, 100% tax-free. That's 36 tax-free checks each year. It doesn't matter what you make already. This simple strategy could work for anyone. Go to www.irsrevenge2.com to learn how. That's irsrevenge2.com.
The Financial Survival Network. It's all about what's next.
And we return. We're speaking with Rick Ackerman of rickackerman.com. You can get his daily newsletter. Just go to rickackerman.com. You'll get Rick's picks. A lot of information there for non-paying subscribers. Really helpful. So Rick, then we've got the auto bubble, where regardless what your credit is, at least up until now, even if you're upside down on your current vehicle, no problem. We'll just fold that into your new car payment, and the interest rate is low, and everything will be fine because it's good for the economy, right?
Well, even if you're in prison, I think you could borrow money and buy an Escalade, have it waiting for you when you get out. But there's no question there's auto loan money for anybody and everybody, and that's why driving through even a poor neighborhood, let's say down there in Florida, you'll notice all the new expensive cars in the driveways. And of course, it's not just in the bad neighborhoods, even in the middle class neighborhoods. There's generally a lot more car in the driveway than most people, strictly speaking, can afford, because so many of the cars are being bought on lease arrangements. The idea being that if you can't really afford a car and a down payment, let's just spread it out over time and pay $400 a month, and it'll be painless. So that's what's fed the auto boom, and there's no question that we've got a boom there. But in the down part of the cycle, we find that people are not going to be turning over their leased automobiles, and they're going to be more sticking with what they've got for 8 or 10 or 12 years. So to me, the auto bubble is just one more booming sector of the economy that's headed for a fall.
Yeah, and fall it will. I mean, you already see it happening where sales are going down in spite of all the easy credit that's available, right?
Well, I think the trigger will be the stock market itself. People usually put the dog before the tail, but I think it's the other way around. The stock market, I suspect, is going to start falling for no apparent reason. And as that happens, as the market goes lower and lower and lower, it's going to color our perceptions of all these things that we've dealt with so easily, with the stock market always pushing to new record highs. And I don't think you can underestimate the psychological importance of the stock market to the overall picture in consumption and all kinds of spending. When the stock market's trading at record highs, no matter what kind of problems are out there, general perception is, well, how bad can things be if the Dow's up there near 17,000? But when the market comes down, it's not going to be because some horrific headline hits the news one day and the stock market just sells off. I think more typically, this has been the case most of the time in the past, it's going to start down for no apparent reason, and the reasons won't be apparent until the Dow is 5,000 points lower. So, if and when the Dow gets down to 12,000, a lot of those problems that we see, systemic economic problems that we've coped with, are going to be a lot more difficult to cope with.
Yeah, and that's going to be, that's really going to be the comeuppance, right?
Well, we definitely need a wringing out of the of debt to put things back on sound footing. And, I've been a perma bear for a lot of years, and I've attracted some unfriendly fire. People say, yeah, you're like a broken clock. Sooner or later you'll be right. And some others will say, you absolutely sound like you want the stock market to collapse. It's true that I do, because I think that the economy is so full of lies right now. It's so corrupt that we really need to kind of wash everything out. We need a huge shakeout to put things again on a solid and honest footing, where people are buying stocks because they're expecting a brighter tomorrow. No one, anybody is cynical enough to see that that's not the way the game is played right now. The buying is not done by people who are bullish on America. It's being done because you got to throw that money somewhere, and of course, as long as they all hang together on that idea, put it in stocks, the market moves higher. So money is going to all the wrong places, as it necessarily will when it can be borrowed at almost no cost. And one of the bullish things you hear about, companies are totally liquid. They've got $2 trillion in surplus cash. My gut feeling is that they're never going to see that money, that whatever takes the economy down is going to be so calamitous that the investment vehicles in which that $2 trillion is parked, they're going to collapse. And so I think that the $2 trillion, it certainly sounds like a lot of money, but in the end it will be as ephemeral and as ethereal as the financial system itself.
Yeah, well, no one can accuse you of being an optimist, huh?
Well, I have a lot of pen pals that I've made over the years, and believe me, some of them make me sound like a sunshine and lollipops optimist. I've got one guy who's made a lifelong study of Nostradamus. He's a very successful developer, real estate developer, but he retired and he's kind of delved into Nostradamus. And in Nostradamian terms, we're looking at a series of world wars, global famine, and an earthquake that puts the new west coast of the U.S. somewhere around Arizona. So my scenario relative to his is practically sunny.
Yeah, Edgar Casey said the same thing, and it hasn't happened yet, but hey, increase in seismic activity, volcanoes, and all sorts of other calamities. But till it happens, I guess the stock market could keep going up, right? And who knows? It's just it's kind of amazing that it's kept going up the way that it has up to now.
Well, we've got one guy who's always kind of a gadfly in my own forum at Rick's Picks, and he makes the not unreasonable case. He says, look, what we've got here is the sweet spot of corporate earnings. We've got essentially pressure on workers. There's relatively little wage pressure, and of course, the companies have used cutbacks in their work rosters to raise their profits. And the margins are somewhat thinner, but they're not doing any hiring. So because inflationary pressures have been relatively low, it's been an opportunity for businesses to get very efficient. And of course, that's had profoundly negative impact on the workforce. But from the cynical and hard-numbered Wall Street perspective, it's produced a stream of relatively consistent earnings growth in corporate America. But sooner or later, you reach that point that Henry Ford obviously foresaw when he said, you got to pay your workers in order to have them buy cars.
Yeah.
So in that respect, you can see this recovery going only so far on the corporate earnings growth side, because they're not hiring, and the workforce is essentially going down the tubes here, and you see that reflected in the spiraling down numbers for some of the big box stores like Target and Kohl's and even Walmart. They've really been hit pretty hard, and even though a story in the Wall Street Journal said just the opposite, I think that the consumer buying power, the diminishment of it, is kind of creeping up the income ladder.
I agree. And on that note, Rick, just tell us again how we subscribe to Rick's Picks and find out more about you.
Go to rickackerman.com, and in the upper left-hand corner, there's a thing you can click on for a free 2-week trial subscription. Obviously, that's a great deal, and when you get there, please head to the chat room. I've got a lot of guys from all over the world who are active traders, and that's where we do things in real time and actually do some trading. So I invite anybody who's listening to give it a 2-week trial, and I think you'll enjoy the chat room.
All right. And you'll find the link on the show notes to this interview on financialsurvivalnetwork.com. Don't forget to subscribe to our newsletter. It's free. You get the first 5 chapters of my book, Forget Wall Street, Go for the Gold and Silver too. Rick, we'll talk with you again real soon.
Thank you, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.